See, it is very difficult to give a range, tight range for 10-year benchmark for next 3 months, 6 months. But as per our model, at current levels of 8.75 to 9% range, 10-year is a very, very compelling buy. And people should use this opportunity to channelize their investments into as long maturity as possible. Having said that, we think that next 1 year you might be able to see that with a very, very high probability that 10-year bond yield comes down by roughly about 100 basis points or more. And that's because basically what we are saying is on the basis of that currency, what it was probably at say 9 months back, where the currency stress was there, now there is no stress on currency. On the other hand, RBI may have to intervene in light of the higher foreign currency flows to the country. Point number 2, the CPI inflation, which was continuing at say 9.5-10% for the financial year of 2012-13, has now started moderating, and this year we expect average CPI to be in the range of 7.25 to 7.5%. Point number 3, oil prices remain almost static for last 12 to 18 months. And going forward also, next 3 to 4 quarters, we expect oil prices to remain stable in the range of $100 to $110 to a barrel, barring any geopolitical risk and that risk pricing basically impacting the oil prices on. But outside the tail risk, we think that bond yield should be probably say 100 to 125 basis points lower from current levels in next say 1 year time. Basically, domestically, there are two main events that are there, or mainly the two factors that will impact the inflation expectations or the price variability in the economy. First is elections, because people will not only hope but they'll rather pray for a more stable government and the election outcome to be favoring one strong mandate rather than a very fractured mandate. It will be very unfortunate for the country to have a fractured mandate going forward. And if we see probability of a stable and strong mandate to single party, whichever the party comes, it will be very, very good for the economy perspective. And then we have to see how the economic policies that will get adopted by the government thereon. So coming back to your question, I think there are two main events, but fractured mandate, if it's the outcome of the election, that will be, that could be a negative thing for the economy and can impact the currency and the rate side also. But we assign low probability for that. We are assigning high probability that it will be a strong mandate. If the election outcome is favorable and the election mandate is strong and it's a big mandate to any single party or the single alliance, then I think currency will be in a much better situation. Sentimentally wise, it will be much better for the economy, for the country. And then we'll have to see how the government, as and when the new government comes, what are the policy that it adopts on the business per se. If there is a stable government and the election outcome is favorable, definitely then currency will be far more stable than what it is, or would be more biased towards remaining. Having said that, I don't think I think RBI will use that opportunity to shore up currency reserve. So the very, very strong appreciation may not happen or looks unlikely, but that will also help Reserve Bank of India to basically shore up reserves, foreign currency reserves, which are probably around say $298 to $299 billion, and I think they will use that opportunity to shore up reserves and to infuse liquidity in the system. Looking at the current fundamentals and the market levels which are there at this point of time, we strongly recommend investments in the highest maturity bucket as per investors' appetite and understanding of the risk associated with the product. And our independent call is that one should be as long as in the as much invested in the high duration product as much as possible. That's basically because we are seeing that the oil is likely to remain low, inflation is likely to remain low, your core inflation is likely to remain low, your investment cycle is yet to revive. Your current account deficit is now running at almost a run rate of 1% of GDP. And with new government coming in and more stable or say more robust policies which are towards reviving investment climate and all, I think it is far more beneficial for the investors to remain in long duration bucket, and that's where we see the biggest juices at this point, the biggest value lies at this point of time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.